Hi, I'm Bob Iotti, partner here with TABB Group, and I'm here with Larry Tabb, founder and CEO. And the topic for today is the loss of market share of the New York Stock Exchange. Larry, we read today in an article in the New York Times about how the New York Stock Exchange has lost market share over the last couple of years. Tell me first what your reaction to that, and to the extent that you believe that that's important.
Well, New York's been losing market share. What a surprise! That's been going on really for the past 5 or 6 years, certainly since Reg NMS opened up the New York Stock Exchange. I don't think that's really much of an issue. I think the real issue when you're looking at the New York is not necessarily the market share that they've lost over the last 5 years, let's call it, but really over the last year and what they've done to consolidate their market, grow their business, and change the strategy. The New York strategy really in the last 6 months to a year has been to buy technology properties and market infrastructure so that no matter where you trade, you leverage New York Stock Exchange products. So it doesn't really matter whether you trade on New York Classic, whether on New York ARCA, whether on NASDAQ, whether on BATS or Direct Edge or one of the dark pools. If they're hosting your infrastructure, if they're providing you market data, if they're providing you connectivity to Euronext overseas or into Asia, that they're going to get a piece of that pie. That, I think, is really the more interesting story than, yeah, they've lost market share over the last 7 years. In reality, they had, because of regulation, locked in market share that really actually wanted to escape a long time ago.
Okay, to the industry professional now that's looking at this from the outside, what does that mean for other exchanges who have, to some extent, captured some of that New York Stock Exchange share, and secondly, that may or may not be keeping up in the same way or have the same model as the New York Stock Exchange has?
Well, long-term strategy is going to be really, really difficult for an exchange. What we're seeing actually is the market share of the major exchanges kind of converge into the, call it 12 to 20% range, and we're seeing virtually all the markets kind of come together, and I think that is being driven a lot by algorithms and by trading machines, that the machines no longer really care if it's trading on New York or Archipelago or BATS or Direct Edge or Dark Pool. As long as it can find liquidity, the machines will direct that liquidity to the proper venue. So the issue then becomes is you need to figure out a different way how to generate revenue. And for exchanges, it's going to be about listings, it's going to be about infrastructure, it's going to be about overseas and global brand. It's going to be less about any particular market.
Now, to some extent, this is what the participants, both the sell side and the buy side firms, really have been looking for over the years, to get some more level of equity around where opportunities are executed and losing some of the dominance and share that the New York Stock Exchange and NASDAQ had maybe 10 or 12 years ago. How does this play out for for those participants? Does it portend in the future to continue in this direction, or do you see a bit of a leveling off? And what does it mean? What does each opportunity mean to those that are trading on the exchanges?
I think the issue is going to be that the exchanges are going to become more competitive. I think market share will wind up closing unless an exchange blows up or something tremendous happens, in which case they'll fall off the map or they'll have to regain their infrastructure and rebuild. But it's a very, very competitive market. I wouldn't be surprised to see a little bit of consolidation. But that said, certainly the BATS guys aren't going to sell because they're kind of in it to create basically a utility. The Direct Edge guys, they're owned by a couple of major players. I'm not necessarily sure they will sell, but they could possibly. It's going to be a very difficult market for market operators, and they're going to really rethink how they generate their revenue. And I think that's going to be that'll be the interesting thing about where we go forward.
Okay, last question. We've seen, as part of the shift in exchanges, we've seen two relatively new exchanges come up in the last couple of years. That's BATS and Direct Edge. Does the current structure of the market support more exchanges in addition to the dark pools and other ATSs? And if so, again, is that a good thing or a bad thing for the participants?
Whether another exchange pops up, I think, is actually immaterial. I think you've got 4 major trading venues that are happening now, plus a plethora of dark pools, and you've got still 3 or 4 different ECNs as well as regional exchanges. Whether another exchange opens up or not, it's pretty immaterial. I think the question will be is what's the business model around it. So I'm not really sure that there's a whole lot of room for any more ECNs or exchanges to pop up. I think what we'll see is a stabilizing of it, because I think the profit has been driven out of it. So unless there's a different way to make money is developed, I think we will see the creation of exchanges kind of stabilize. Now, dark pools is another issue. I'm not sure we've seen the end of dark pools unless they get regulated in some way. If you're a big broker, it pays you to have a dark pool. If you're in control of order flow, it pays you to be a dark pool. So I think to that extent, I'm not sure that we've seen the end of that, but that's a topic for a different tape.
Okay. Thank you. This is Bob Iotti here with Larry TABB on TABB TV.